So that data has allowed us to do a lot of things. Here's one test that we did. I took the highest market cap. These are the stocks that have huge capitalization, and we bought the high ones, and we saw how did they do prior to the crash in 2008. They did about 12% a year, the big capitalized stocks. If we looked at the lowest cap stocks, they did almost 18%. Whoa, there, look at the first chart again. High caps do go 12%, small cap stock, a lot better. Small is good. Big is really hard to get a big stock to have a large percentage gain because the mass of the volume, the capitalization, is hard to drive that price up. So it's a huge rule of investing, and we're going to make it a lot better and a little simpler for you as well. But there's a big rule to remember there. What if you buy the 5 highest debt to equity stocks in the Dow? These companies have a lot of debt, right? And a lot of blue chips have a lot of debt. Debt's not good. You just want to get rid of debt, whether you're in a company or whether it's personal. Those stocks on average about 7%, the high debt stocks. The other side of that, let's question and say what happens to the companies that don't have debt, the low debt stocks, and they do almost double, 11.69%, almost 12%, a lot better. And the only criteria we looked at was debt. That was it. Didn't look at PEs, price sales, nothing other than do these guys have debt or not. So clearly the takeaway here is stocks with high debt you want to avoid. You've already set it against you if you're buying stocks that have a lot of debt. So within an average of the Dow or the S&P, you want to screen for stocks that don't have debt. They perform on balance much better than stocks that have debt. One of the problems with the startup companies, the high-tech startups, they have a lot of debt. So a lot of them crash because they can't handle the debt charges. So debt's a really critical number to look at. Another thing that we looked at is to look at the highest return of equity. And the stocks with a high return on equity, and they're making money, almost 18% return. In this study, we bought the 10% of the highest, in the S&P 500, we bought the 50 highest priced stocks, the top 10%, based on just the measure of the price of the stock, nothing else involved at all. We just bought the top 50 highest priced stocks in the S&P, return on average 14%. We bought the lowest priced stocks, 20%. Well, there's a big difference, isn't there? Only criteria, high price or low price. That's all we looked at. The low price stocks outperform the high price stocks. And there's a reason why, which I'll explain to you, the law of the square root. But on average, low price stocks beat high price stocks. Please.
The test is for the high price stock are done on the first trading day of the year?
Yeah, we just bought on the first day of the year, exited the last day of the year, just to see on average how they did. Or and this is maybe a 12-month hold versus a 9-month hold. We had to buy them at some point. You could buy them at a better point. But I just wanted to see, is there a difference between debt and no debt stocks? Oh yeah, there is, isn't there? Between high price and low price stock, big difference. Between high capitalization, low capitalization, big difference. So suddenly, this world of investment, we start to say, hey, we've got an advantage over here. We have an advantage buying low-priced stocks. We have an advantage buying low-priced stocks without any debt. So we can start to kind of nest this stuff together to find better returns on our money with less risk. There are a lot of value measures I tested to see how they did. If we look at low price to sales stocks, they were 15%. High price to sales stocks, not good at all. Low PEs, good. High PEs, actually not bad. Some stocks with high PEs continue to do quite well because they're momentum-driven stocks, but certainly low price to sales and low price to earnings are the really big valuation models. It used to be price to book, which is what Graham Dodd wrote about. It hasn't worked for a long time. You got a lot of the laggard stocks. Price to sales and the PE ratio, been around forever, is still a really good indicator of future market activity. If we buy the 50 highest price to sales stocks, that's a ratio of the price of the stock divided by the total sales of the company. On average, they had done 14%, whereas the low price to sales stock did 20%. A huge difference based on just one little number, price to sales. That's the only number we looked at, and that number did substantially better. So we're starting to see we can find values in blue chip stocks. Really important point here. These valuation models are built on blue chip stocks. They will not have or as much application on high tech stocks, on startup stocks, because that's not the universe. I like the universe of blue chip stocks for a couple of reasons. One, they've been around longer, they're aged like fine wine. B, they have very good management, they've been in business a long time, they have good managers, they have large volume. I can get in, I can get out, not a problem at all. I can buy 10,000 shares of a stock in the Dow like that. I can't do that in a lot of other stocks. They don't have as wild gyrations as other stocks. I like that. They're more predictable. That means the rate of return may not be as high as well. So we need to try to amp that up. But they're a lot easier to get in, get out, and follow. Question, please.
Yes. On these analytics, was it just for the Dow, or did it include the S&P?
This is the S&P.
Okay,
This
thanks.
is the S&P. And I know that because we're buying the 50 lowest. And there's only 30 stocks in the Dow, so it's got to be the S&P.
Gotcha.
Okay? But the same thing tests apply to the Dow, the S&P. The low price sales stocks in the Dow outperform the high price sales stocks in the Dow. The low PE stocks outperform the high PE stocks in the Dow. Just universal truth that it's been hard for me as a technician to accept that fundamentals can work. Come on, I want charts to work. But I finally had to give up and say, no, fundamentals matter. They really matter a lot. So here's the big one. Do you want value or growth? This is the cocktail conversation I have all the time. Oh, you're a stock guy. I don't tell them I'm a commodity guy. Because if I'm telling them a commodity guy, they just walk right away from me. I could just be a bank robber just as well as to be a commodity trader. But it's, oh yeah, stocks and bonds. Oh, stocks and bonds. Everybody, oh, they want, what do you think of interest rates? Suddenly you're respectable. And they want to know what growth stock I should buy. And I wouldn't touch any of them with a 10-foot pole. They go, what? I said, no, you want value stocks. No, I want growth. I'm a young person. You want value stocks. Here's the proof. If we look at the annual return of value stocks versus growth stocks, I think this is the Fidelity Fund. I forget which one we're looking at here. We'll look at several. The U.S. market annual rate of return on average 11.8%, value stocks 16%, growth stocks 11.3%. Growth doesn't do as well as value. But you would, another generalist word, growth sounds like it should do better, right? Value sounds like for old guys like Larry. Growth sounds like, oh yeah, it's going to grow, I'll make a lot of money. What a great sales pitch. Just put one little word on it, growth. I'll make a lot of money, it's going to grow. But the reality is the value stocks grow more than the growth stocks because value stocks, why would that be? They're aged. They're not upstarts. They've been around. They're the Altrias. They're the General Mills. These are companies that have been around. They're well entrenched. Their growth, almost by definition, they just started to grow really well now, but they have growing pains. And they don't do as well, on average, as value-driven stocks. So I'm all about value for us as long-term investors. As a trader, totally different ballgame. But for long-term investing, you want to manage money, which you could do with the strategies you'll learn today. You want to focus on value. You don't want to focus on growth. And all the studies that we do. I think we have another one here, Harry. Here we look at Fidelity small cap. We know we like small cap stocks, right? So how about Fidelity small cap growth? 10-year rate of return 9.25%. So that should be really good. Small cap growth, that's about as good as it gets. But if we look at small cap value, 10.46%, it does better. Small cap value beats small cap growth. Who would have ever thought? But if you really think about it and do the work on it, you're going to come up with what we've come up with from looking at the data. Because like you, I first thought that obviously growth would outperform value. It just sounded logical. But in fact, it's the other way around. Value exceeds growth as a long-term investor, which is another reason to be in the blue chip stocks, because for the most part they're value-driven stocks. The Dow or the top stocks in the S&P 500, these are value-driven stocks, not growth-driven stocks. So I'm all about value based on what I've learned about the marketplace. Does that kind of surprise some of you? Do you think you always thought growth is what you're looking for? Yeah.
So do you just like to stay in the indexes then?
Pardon?
So do you just like to stay in the indexes?
I want to stay in the Dow Jones Industrial Average because it's really simple. I've gone from 16,600 stocks to 30, and then I'm just going to find some good value stocks in the Dow, and I'm done. Isn't that nice?
And you do those stocks rather than the whole index?
Yeah, because we can beat the index by a lot. Question? Yeah.
How do you define value in growth stocks?
How do you define value in growth stocks?
How do you define value and growth stocks?
Growth would be primarily momentum, how much their earnings are increasing. Of course, if they're earning fast, then that can decrease. Value, you're going to look at price to sales ratios. You look at EBIT, or earnings before investment income taxes, to look at value, growth. And we'll look at that in a moment. You'll see the differences. Yes.
How would you account for these large buyback programs that are going on this year with the valuation?
Question is, how would I account for the large buyback that companies are doing? I don't know. I don't have the answers to all this stuff. It seems like if they're buying back, they're really bullish on the stock. They want to liquidate the stock so they have less dividends to pay. They have more money for themselves. So I think it's really bullish when companies buy back their own stock. That's the only comment I could really make. So if we look at best value fund, because a lot of you say, Larry, I just want to be in a value fund. I don't want to have to do any of this work. I'm going to buy a value fund, put it on the mattress, and wake up in 20 years, or give it to my kids or whatever. These are, based on our work, are the best value funds. My favorite actually is the Fidelity Value Discovery Fund. If I had to just be in one fund based on value, that would be it. And you could go to Vanguard or Fidelity or Magellan, any of them, but I like that. That would be my favorite. Here's a nice value fund. You can buy that, put it away, and be happy for the rest of your life. You can do some market timing on it if we get like the yield curve, right? Or unemployment numbers start to collapse on us. Well, then we have some timing situation. You might want to move to cash. But until we do that, I think that's a great value fund to be in, so you don't have to figure out all the value stocks on your own. Just buy a value fund as opposed to a growth fund. I know a lot of you have money in 401 programs, defined benefit programs, things of that nature. That's what I think you should have in that account as opposed to trying to capture high tech or growth. So we want to look at value ratios, which we can look at any stock. If you look at price to book, 9-month rate of return prior to the bull market have been 18%. PEs, though, and 12-month forward PE and low price to sales all did much better than price to book. May explain why Buffett performance has not been good in recent years as in past years, because he's focused on price to book, whereas low price to sales and 12-month forward PE has been the best. In fact, the best has been 12-month forward PE. I want to talk about that, explain that to you a little bit. It's a little bit of a strange number. It comes from analysts predicting that we think in the future the price will be here, the earnings will be there, so a bunch of analysts work and arrive at the forward PE ratio for a stock or for a market average. Never meant anything to me at all. But one day I'm reading this report for my friends at the Federal Reserve System. I go, oh, they say in the Federal Reserve report, the most important value measure for the stock market, for the Dow Jones Industrial Average, is a 12-month forward PE. I go, whoa, the Fed just said the most important number is a 12-month forward PE. Holy Toledo, I woke up. I never heard that before. 12-month forward PE, the Federal Reserve said is the most important number. That's what they look at to measure stock prices to see if they should goose the economy or not goose the economy. So that was a cathartic experience for Larry Williams. And I started looking at the 12-month forward PE ratio. And in fact, what I found out is they're right, that the best predictor of future performance is the 12-month forward PE ratio. And here's why. You can have stocks that have a good price to book measure. They may have a nice price to earnings or low price to sales. But if the forward expectation is they're not going to make money, they're probably not. A few years ago in the Dow, there were 2 stocks that had good price to sale measures. They had good current PE measures, but the 12-month forward PE was 0. And those stocks fell apart. But if you had looked at just current PE ratio, current price sales ratio, price to book, it looked like nothing was wrong with the company. But the forward measure of earnings wasn't good, it was negative, and those stocks just collapsed. So again, back to the Federal Reserve, these guys are onto something here when they talk about the 12-month forward PE ratio. So we're going to use the 12-month forward PE ratio as our key value to measure stocks. We talked about low price stocks being important, that they have bigger moves. Here's why low price stocks outperform high price stocks. It's called the law of the square root. It's been around the stock market for a long time. Some of you learned this from me, most of you have probably never heard of it. Basically, stocks move in units of a square root. If you think about that a little bit, the square root of 100 is 10. So a stock has a square root movement of 10, it's gone up 10%. But if a $4 stock has a square root movement, it'll go up 2 points. That's a 50% gain. It's easier for low price stocks to go up than for high price stocks to go up. It just takes a lot of energy to take a $300 stock to 400, but it doesn't take much energy for a $10 stock to go to 13 and get a 30% gain. Low price stocks are what it's all about for a higher percentage rate of return. So I want to focus on low price stocks in a blue chip group that probably has longevity because they're aged stocks and are earning money and will continue earning money in the future based on the 12-month forward projection of their earnings. Now we can look at earnings in a lot of ways. I'm going to share with you some really interesting studies that I did. I thought I had just a brilliant idea. Man, I thought this was just so smart. It wasn't, but it's an interesting idea. It will tell us a lot about the market. The red line that you see here is the Dow Jones Industrial Average. And I thought if I were to take the spread between the forward PE, let's say the forward PE is projected to be 12 and the current PE is 19, that would be a positive spread, and the stock that had a better projection of a PE in the future than now would way outperform the Dow, and they do, but by not much. And the ones that were underperforming the Dow would underperform the Dow, and they did, but not much. But we can learn a little bit. While the spread shows us clearly the ones where the projection is better, we do outperform the Dow, but I mean, not a whole lot. And the ones that don't have as good forward PEs, they underperform the Dow, but not by a lot. We're going to see a lot better numbers in a little bit. But clearly we start to see that the relationship of the 12-month forward PE is significant. If the spread is positive, we outperform the Dow. If it's negative, we underperform the Dow. So we're onto something with the 12-month forward PE ratio here. We just don't know quite what it is. So another thing I wanted to do was look at the price of sales, which has been the index that people have fallen in love with in this business. A lot of mutual funds are driven by price to sales ratios. So again, we're going to look at the Dow, that's the red line. And then I took the 5 highest price to sales, and that's this line. And then the Dow is the very top line. The light blue is the lowest price to sales. The lowest price to sales has done about like the Dow. It's hard for you to see that in the back, I apologize. But that's done as well as the Dow. Prior to the crash of 2009 though, look at the price to sales way up here. Price to sales exceeded the Dow Jones Industrial Average. But when we had the crash, the game started all over again, and those price to sales, the good price to sales, have just emulated the Dow. They have not done any better than the Dow. There's a new valuation measure going on in the Dow Jones. The one that's done the worst is the highest price to earnings, which you would expect. High PEs are not good. So high PEs have underperformed the Dow. High price sales have underperformed the Dow. but the old indicator of low price to sales used to be good. The last really 15 years, it hasn't been that good at all. There's no difference. So that really focused me in on what's been the most consistent as a valuation measure for the marketplace itself. So if we look at the 10 lowest positive forward PE, I took the 10 lowest positive forward PE stocks and did a 3-month roll with them. And again, the Dow was in red. They outperformed the Dow, but not by very much. This is where all these studies got really interesting. My programmer at Quantitative Analytics, been programming all this stuff for 15 years for me. We were with him this weekend in New York. And I said, hey, you program my stuff, and you program a lot of stuff for a lot of funds that pay you guys a lot of money. I don't want to know their secrets, but I just want to know this. How does their model stack up against my models? How far back am I versus what they're doing? Because I want to see relative. Are we good or are we bad? Where do we stack up in the pack here? He said, oh, Larry, they are not even close. I said, really? He said, no. Their models are coming in at 12%, 13% annualized rate of return. They're not even close to what we're doing. I said, well, you keep your mouth shut to them then, please. So in all of my research, 2 values have stood the test of time: the price to sales ratio, the 12-month forward PE ratio, and in both instances, the lower the better. You want valuation. We can measure that by low forward PEs and low price to sales ratios. So those are the best valuation measures. And my gosh, as you see, we've looked at debt, we've looked at earnings before taxes, after taxes, insider buying. We'll look at some of those a little bit as well. But the bottom line, these 2 stand out singularly as the best measures of valuation for quality stocks.